Dave Putz here from JKP Holdings. Alongside me, as always, Mr. Nathan Turner.
Hello,
All right. How are you guys doing?
hello. Good. We're on the road. We're
Oh my,
currently
where are
in
you
Utah.
at?
We're on our way home. We're right now in Centerville, Utah, and then heading up. My daughter got accepted to a college up in Idaho, so we're going to go see that place. She's never actually been there. She's been accepted, but she's never actually been there, so we got to go check that out on the way home.
Nice. Nice. Awesome. So I know Nathan's on
Yeah,
a camera thing, so our videos will be a little wacky. I'll fix it as we talk here. But today we're gonna be talking about bridge loans and hard money notes. And it's something, Nathan, have you ever got into that kind of space?
I'm really curious about it. I've looked at it from a few different people that are doing this. It looks like it's a really interesting investment opportunity. It's something I want to learn more about. So I'm glad that we've got a guest on here today.
And I know that it's big space right now, right? I know that we're curious about because it's a much different angle in all this play. So for those who are curious
Mhm.
about it, we will have this replay. This will be on our YouTube channel as well as our podcast. So you won't miss a thing. It is being recorded. So um, what's been new with you besides taking your kid to all his college stuff? What else you been up to, my man?
I took the last couple of weeks. I'm supposed to be raising money from my fund, and I was like, you know what? I've got too much going on. Capital raising's going to the side for a minute. We're figuring out DME. So while I've been away, while we've been kind of away on this semi-vacation, just about all the sponsorships are sold out. So if there's anybody who wants the sponsorship, speak up now. And speakers are all set. Just got a couple of speakers that I got to lock in, but DME is coming along together really well. We've got just under 2 months till
Yeah,
showtime, so we're getting very excited for that. Looking forward to seeing
it's
everybody
quick.
there, and
And for
yeah,
those who
it's
don't know what
good.
DME is, Diversified Mortgage Expo, it'd be happening in Nashville at the end of May. It
Mhm.
will be a combination of note buyers, note originators, and experts around the way, service providers, everything else. So it's definitely a different kind of market than you've been to. Most we
Yeah,
found seller finance people don't have um, a a conference to go to. So it's definitely a whole lot different than what you think it is, right? Getting together with people that
yeah,
you're experts in the room, really knowledgeable people all in the same room with stage and all that stuff. Looks all pretty and fancy and all that stuff. And you get together and network. That's our biggest key here is networking and getting deals done, buying and selling, trading and learning about it.
you have to get to know people in the space. Like it's so. We say this all the time, but it can't be more true in this space, especially. It's all about relationships. So it's all about getting face to face with those people that you're going to be doing business with, because that's how you grow those relationships, and then that's how you get deals done, that's how you get business done. So
Yeah.
I highly encourage everybody to come out, get to know people in the space, meet, like you say, service providers, vendors, like, and I it's not just anybody that can come. I'll give you an example. So last week I had someone reach out that wanted to be a sponsor at the conference, and I said, okay, sure, can you tell me a little about your company? I haven't you guys before. Medical devices, and I'm like,
Yeah.
what? That has nothing to do with anything. So the answer is no. No, we're not. It's not just free for all. Anybody who can come. The people that are coming there are people that are in the business that I've worked with personally, that you've worked with, Dave, and people that we
Yep.
know are real assets to your business. So it makes a big difference just to be there in person and getting to know people.
Awesome. Yeah, I did see we had a little audio trouble. I did fix that. I don't know why it did what it did, but it is what it is. So I think for me, DME was allowed me to connect with people that are not in the note space, right? Or not in the note buying space. And picking brains of people like we're having guests on today, saying, I don't understand why you do this or that, and kind of get a better understanding from their point of view so that I can be a better buyer of these notes and say, how can I put myself in a win-win scenario that allows you to
Mm-hmm.
grow your business, me grow my business, and we all win, right?
Yeah.
Um, we have certain things we got to hit individually, but that's where it comes back to. So it's cool.
Yeah.
Well, let's jump right into it, and we'll
Yeah.
bring in our guest. I'm going to call him Matthew. We haven't correct anything else. Is Matthew good or Matt better, or you tell us?
Either one. My friends call me bad words, so it's not really, you know. Matthew
I
is
hear
totally
that.
fine.
Awesome. So, Matthew, tell us a little bit about your background. How'd you get into real estate to begin with, and how'd you get into the niche you're actually in today?
Yeah, no problem at all. I appreciate the invite, and looking forward to sharing some of the knowledge and the new income strategies that come with investing in different types of notes and things like that. And so I'm a CPA, so the math stuff to me is really an unfair advantage, especially in the note space when you understand arbitrages and things like that. It's really interesting.
Mhm.
I didn't know any of that in the beginning, right? I worked at a CPA firm doing tax and audit, got to work on some larger real estate clients and things like that, and didn't know what I wanted to do. Was just bored out of my mind, wanted to bang my head against the computer, going, I can't do taxes anymore. I can't help the government steal people's money anymore, you know. So and I just had to like do something else, but I didn't know what to do. I'm like, should I start a bar? Should I like what the heck should I do here? And actually, my stepbrother came to me with some education on real estate, and I ended up being extremely passionate about that. And I got my first deal under contract that I was going to flip, and this was in 2006. And so I went and got the deal under contract, quit my CPA firm job. I had about 30 grand in savings and just said, forget it. I'm going to be a full-time flipper now, with like a year of real estate education and no real experience at all doing
Oh
it.
my
And
God.
so, yeah, I was like, I'm just thinking in my head, I didn't have kids at the time. I could go back to the CPA firm or another firm or whatever, you know, but something different that didn't want to make me cry every day of boredom. You know what I mean? So, and so I ended up quitting. We started getting a lot of properties under contract. Actually, my two stepbrothers, both computer programmers and electrical engineers, both quit too. We got an office at the World Trade Center in Long Beach on like the 23rd floor in 2006, thinking we knew what the hell we were doing and thinking we were dope because we were flipping a bunch of houses all of a sudden and getting a bunch of properties under contract. And then, of course, 2007 happened and 8 happened, and we realized we were not dope and we had no idea what the hell we were doing. And, you know, I thought we were good business owners because my books were done and I'm a CPA, right? I'm still a technician in my mind at that point, right? So,
Mhm.
and I ended up taking 200 grand out of my credit cards. I paid my investors back with that because my investors I had a 790 credit score. And, you know, back then you could get lines of credit like crazy. And I'm like, raise it again, raise it again. I'm going to
Mhm.
use this to buy real
Wow.
estate. And so I went and we had a bunch of private investor capital involved, and we took like 50% hits on our acquisitions during that time because we bought like 36 houses with all our investor capital and some of our capital, and we are going to lose like a couple 100,000 of investor money. So we just basically we took it out on our credit cards and paid it to them, and went down with the ship and pretty much lost everything. It was probably the most humbling experience of my life, you know.
I can
So of
imagine.
course, and my ego was destroyed at that point, which was probably the best thing that ever happened to me, honestly, because now I'm like, where's that left hook going to come from? You know, even if I have a lot of experience now doing this, you know, back then, that punch in the face was like, you realize how strong you can be by standing back up after something like that, you know, and you need that because you're going to get punched again, you know. So
Yeah.
uh, and so since then, we flipped a little bit over 1,000 houses now. We have about
That's
35
wow.
million lent out to flippers in different markets around the country. I've raised a little bit over $150 million for real estate. The CPA license helps with that, of course, you know, with the
Yeah.
raising the capital thing. And, you know, we invest in all different types of syndications, from mobile home parks to multifamily to debt structures, other private businesses, and a lot of different debt structures, not just hard money and things like that. But I really love the debt aspect of things
Yeah.
quite a bit, and there's benefits to that and benefits to real estate directly, of course, within the tax code and long-term wealth building and things like that. So that's kind of my story. I live in Southern California. I call it communism for the people out of state in different areas,
Mhm.
and but I don't pay taxes really because I'm a CPA and understand the strategies. And so but at the end of the day, you know, I have a couple of kids, and I really just love the note business because it can be a lot more passive than, you know, actively flipping and actively being involved in real estate. And I want to spend time with my kids, you know, my 8-year-old
Yeah.
and my 4-year-old. So it's
Oh,
pretty awesome. So,
yeah, that's
but yeah.
awesome. So when you first got started, how scared were you?
I think I was naive at the time. I thought, hey, I'm gonna have time to go to the gym now every day, and I'm gonna have all this extra. I don't have to drive to work. That saves 30 minutes. You're like, what is 30 minutes if you're an entrepreneur and a business owner? Like you're like, oh, okay, yeah, work 14-hour days now instead of 10, or at a CPA firm, right? Or 8, and
Yeah.
actually care now instead of before. Like you're emotionally connected much
Yeah.
more, right? And so, yeah, and realizing the ebbs and the flows of the emotional aspect of things was key. But I think I was scared and nervous, but I felt like I had something to fall back on. If I don't know that I would have done it all over again if I knew how hard it is, as far as just jumping ship without having like a set income stream. So everybody has their own differences. I didn't have that much to risk at that time because I didn't have, kids or anything to take care of. If I had kids now, it's a different story. You have to eat, so, but yeah.
Yeah.
Good
Absolutely.
stuff.
That's amazing because I think people, they think entrepreneurs, they think freedom and opportunity and lifestyle, and you're like,
You're like, no,
yeah, no,
I don't think so. Not yet. So you're
There's
building
work
towards
involved.
that.
yeah,
Yeah, there's work involved, and yeah, that's a good point because people coming into the business are like, oh, so notes is like it sounds really easy. Sounds that way, doesn't it? Yeah.
yeah,
It's funny being a hard money lender. I feel
Yeah.
like I'm a property management company and a flip company because I have to manage the renovations still, and then I have to deal with collections when people just ghost you for no reason. Like we've had people close on a property, literally put money down on the property, and then never speak to us again. And we're like, what is going on? Like, and we just, okay, thanks for the 65% loan to value house, So like and so it's just interesting. It's crazy, this business. There's still very much activity or activity that needs to be handled by your team if you want to be passive. It's like any business. If you don't build your team from the start, you're going to be, self-employed. And I had to learn that the hard way myself, just like most entrepreneurs.
yeah, absolutely. So it's amazing that, we talk about this stuff. And for me, we chase a lot of different things, but what is your typical term of your notes that you're creating now? Are they 6 month, a year? Where are you at in your creation of the notes you're creating?
So I do a number of different notes. So a lot of it depends on the strategy that I'm deploying. Many times I buy, renovate, and turnkey properties, and then renovate and tenant them, and then resell them to another investor that wants the cash flow. And I'll sell them to people's IRAs and 401ks. Usually maybe 7, 8%. It depends on what the cap rate is of the property, of course. But I'll fully amortize it over 15 years and sell it to their IRA or their 401k, or I'll structure 1031 exchanges for people based on that rental property and structure the debt piece, the equity down payment, and hit the right metrics for people's 1031s. That's one of the big strategies I started with. It got me into the hard money lending space on construction debt, and what taught me the ropes on being able to say, okay, how do I mitigate the risk on this construction debt? And knowing the renovations and the flip side of things, and then coming right back into the construction side and the lending piece of it was kind of a perfect play because I knew where the risks were. Not that I didn't make mistakes and get punched in the face and had make realize that, wow, not everybody is a CPA that understands money management, and cash bucket systems for your properties and things like that, right? So but at the end of the day, my typical structure now, if I'm lending to the general public, usually, or people flippers in different markets around the country, I usually stick first with certain markets that I like to invest in that are non-judicial foreclosure states, so that I don't have to go through that process. That's bit me in the past, of course, where it takes 7 months or 8 months to foreclose on a property because some issue there. You also want to make sure you know the neighborhoods really well and the borrowers, because if you market the wrong wrong terms to your borrowers, you're going to have the wrong borrower. So we went through in the beginning, right now we're doing 65, 70% loan to value loans, maybe at around 12% interest rates, 2 flippers with them putting, 90% of cost usually of purchase and renovation, and they got to pay for the entire interest up front on the loan. And we hold that in reserves, and we hold back the entire renovation in reserves. So usually it's like 6 months of interest hold and then the full renovation hold, so that way we can apply those payments. So they're not having to make payments during that process, and they know where their cash is, so their money's in up front on that piece of it. And it's usually usually 70% max loan to value on the after repaired market value, and then construction draws as they finish the renovation with inspections each time they do a draw, so that way we're really safe. We're usually doing 1-year loans, but sometimes we'll get extensions, especially when the interest rates change and things like that. People are waiting to see are rates going to drop so I can refinance on a debt service coverage ratio loan for my rental in that scenario. And one cool thing that actually happens out of this is, one, I get a ton of deal flow just by lending to the direct public like this. And I'm like, oh, you don't have the money to do this, I could take it down, and actually partner with some of them. It's bit me in the past on certain partnerships, and doing the homework on those partnerships are key, of course. But being able to come in and say, hey, you're having a hard time selling this property off, maybe you can do seller financing to a homeowner, and then we'll leave my loan in place, or I'll help you out on a long-term rate instead of a 12% short-term rate or something along those lines, and make my interest rate spreads between myself and my investors, and they can go through and make their spread on their equity piece of the deal too. So it kind of plays to each other, but that's my typical terms: 12 months, 12% interest, maybe a couple of points each time or something like that, unless I have a very big borrower, in which case we usually drop points or make it a very, easy type of fee for really big borrowers that are working with us for a long time, so.
That's a lot.
Interesting. So one of my concerns, with the short term, how do you ensure? I don't know. To me, it just seems like there's a bit of a risk in there, in that maybe they got in over their heads, or maybe they've got in where they, I just don't know how you do the due diligence on that to make sure that it's a good loan 12 months from now.
Yeah, absolutely. And that's the hardest part, right? Is the due diligence, and knowing what to look for when you're analyzing these types of deals to see if it's a good fit. The first thing, just like anybody you're doing business with, is who the heck am I dealing with in the first place, and what is their experience in doing these deals? Can they show me their last 5 HUD closing statements on their purchase and their sale, and show me that they actually did that? Can I see before and after pictures? Do they seem buttoned up? Are they communicating correctly on their correspondence with me, like quickly, and being able to, provide proper documentation? What does their rehab bid look like in the first place? Is it just, BS numbers where it's not detailed out, or is that on like a chart that they use every time, cookie cutter, with every line item outlined in depth, where they're even on an initial estimate, right? So you're gauging who that person is from that regard. And then the other big risks, the biggest risks here are, their experience, what I just talked about, but also, do they have cash? They're in their cash reserves. And is those cash reserves going to other projects that they have in process, or are they staying on, are they available for your project only? Do they say, hey, they got a couple of more flips going right now? Okay, great. Then, like, do you have the money for those? What's left on the rehabs of those? Are they done? Can I see pictures of those, where they're at right now, and the full budget and what you spent on that, to make sure that, you're not going to commingle, because that's how flippers get in trouble a lot, is, running out of money, and then on the other side, the other biggest giant risk, obviously the appraisal, and the appraisers are not always right. And if you're investing in a market that you don't fully know yet, then you need to make sure you get another check and balance. So we do our initial internal underwriting of that value. We go get an appraisal done also, and then we also get the opinion of another outside agent to be able to tell us, what does that street look like? Because the appraiser may be looking at something a block away when that street sucks, you know? So
Mhm.
it's like, we've been bit by that. These are all things we've lost money on in the past and learned. And then the final
Do
thing is
you?
the renovation bid in the first place, right? Because
Yeah.
some people sit there and they'll tell you, oh, I can get it done for 30 grand. I'm like, no, well, I
Mhm.
can't. I can get it done for 60. And so I don't care if
Mhm.
you're doing the labor yourself or their contractors underbid the job. So you can get what's called a feasibility report and get, because you're not dealing with homeowners in a lot of time where it's more difficult to get into the property, do an inspection. You're able to get full access to this thing, get into the basement, like have them take the bid and have the feasibility company come out and literally look at it line item by line item and say, is everything here? And does that seem right for how much cost this is going to be in the first place? We don't do it on
Mhm.
minor rehabs, but major renovations,
So
usually over
feasibility
75,000, we do
company,
that.
would that be like a general contractor comes in and kind of overviews and says, this is a real project and they have real numbers on it?
Yeah, yeah.
Oh,
So
didn't know
and
that
it's
existed.
crazy. And it's what's interesting now is there's even softwares out there. So during the process, that's another issue, right? What if something comes up during the process that's not on the actual bid, right? You got to
Mhm.
send an inspector out there to say, yes, you did 45% of the HVAC work. Here's 45% of that budget line item. Oh, you saying you spent $20,000 on the foundation. Well, that wasn't on your rehab budget. And so therefore, because it's not in your rehab budget, you're not getting reimbursed for that. That's an overage on you in this case. Now, if you are under on something else and you finish the roof and it was 10 grand instead of 15, we'll disperse the full 15. You can cover your other rehab overages with, partially with that, but it's very meticulous because, that's the issue, right? What's the quality of work? Is it really done in the first place? Because contractors, quite frankly, I hate them,
Yes.
because it's after flipping 1,000 houses and owning my own property management company and stuff, you're just like, yeah, dude, like that's like the hardest team member to deal with. But so those are some of the big pieces from a due diligence and process standpoint. And now what's
Wow.
cool, there's even tech out there that you don't necessarily have to send a full inspection if it's like a minor draw, but your borrower can be at the property taking pictures and they can do geo-targeting to know that
Oh,
they're at your location taking pictures
Cool.
and
Mhm.
things like that. There's new tech coming out with all that that's really interesting from a due diligence and processes standpoint. So
oh my Lord. I'm
yeah,
excited.
crazy.
So let's flip the script on this, right? You have a bunch of people on here who are creating notes, doing seller fans or rap notes, and it seemed like this is more lucrative, but it's a little bit more risky in the fact that you need to know your stuff before you get into this game, right? Where rap notes is just you wrap a note and you put a borrower in place and you do RMLO and underwriting and bill your pay. You're really managing a construction job per se, as well as being the lender on the project. That's a lot of work.
Yeah, and so what really happens is, you have a servicing company along with maybe an internal staff to be able to do that piece of it, right? A lot of lenders will do it in their own market only so that they can actually go out to the property themselves and see it
Okay.
too,
Yeah.
as well. But in reality, we have servicing companies and we also have our internal servicing staff that does the internal reviews of the construction jobs, and then you're just sending out vendors for each draw. And usually there might be 3 draws in 12 months, and you charge a fee for that, right? And it covers that fee covers your team, covers and the servicing, all that kind of stuff is basically handled through that fee structure. Maybe it's $275 a draw or something, and you got to pay the inspector to go out there and then your team to do a review, right? So you're just talking about
Mhm.
labor hours that you can do that. And there's different risks with this type of business. In my eyes, you could do it on your own and use your own money and make 12% on your money or 10% on
Yeah.
your money to quality operators. If you're going to scale it, then of course you need to be able to have private investor capital to be able to make interest rate spreads. And you got to make enough to counterbalance the downside risk if something is to happen. We have funds that we utilize and we use a lot of private investors capital on our side, and we sell them notes and then we have them invest in our funds. And so
So
by
let's
pooling
let's
it
talk a little
together,
bit
it's a
about
lot
that,
easier. Yeah.
right? Because we have a lot of people on here who are also note buyers.
Hmm.
Yeah.
Nathan and I are both note buyers.
Yeah.
If we were going to buy a note from you,
Hmm.
what is a typical? I mean, for us, we don't want to do work. We're lazy,
Yeah.
right? We don't want
So
to
I
manage
don't want to
construction
oversee a
stuff.
construction project
I hear you.
at
Yeah.
all.
Yeah.
Yeah.
What would a process be? And what kind of rate are you creating these notes at? that would allow maybe a note buyer to come in and buy a partial or full thing. How do you structure that if you do sell?
So what on the sale of these things, many times I'm just selling them directly to my fund. My brokerage closes on
Gotcha.
them and sells them to the fund, and I basically go through and do 100% pass through of the entire note over to them, and I use an assignment of deed of trust and a
Yep.
longe, and the note purchase and sale and servicing agreement basically, and my servicing company basically retains the spread interest.
Gotcha.
And so if I'm coming in and doing it in a fund, I give it all the fund because I get the excess profits anyways. If I'm doing it with private paper, with private investors, I'm assigning usually the full note to them on those notes. Sometimes it'll be a partial, but and I allow it to be an AA structure so that way everybody's on equal playing field. If I'm selling one partial to one person and another partial to another one of my private investors, or just keeping it for myself for my internal, because the interest rate arbitrage is pretty nice on my own capital as well, right? So,
Yeah.
if you do the math on this, it's insane how much of an interest rate spread some of those arbitrages make on your capital. And so, if you're coming in, and we assign that off to them, then it's usually a partial, and we'll do an assignment of deed of trust and all that stuff, and have that handled there. But we do all the work, and so usually it depends on how much capital an investor has. If one investor is buying like one note for 100 grand or a couple $100,000, usually I'm at like a 8% interest rate, and I retain the remainder. I usually pay up to 9 if they're investing over $500,000 with us on our stuff, but it's hands off. They not only don't have to do any work. We do all servicing, everything. But we lose our spread first before they lose any money. We go through handle the foreclosure process and take any of the, we're in basically first loss position on that piece of it. And then we also go through and continue to roll their money over and over to new notes as things pay off, so that we say, okay, hey, they have this money that's about to get paid off. We have these new notes coming. Do you want us to roll it back in, so that they have a consistent supply of notes coming in with uninterrupted interest? And we got a lot of investors of ours that are just like retiring and traveling off this, making 30,
Yeah.
40 grand a month, with us. And it's just, that's pretty awesome when they can do
Fun
that. And,
stuff.
in the beginning, it took time to develop, large capital sources like that to do that. But over time, as they trust you, and in the beginning, we were putting our own money in where they'd fund 60% of it and we'd fund the rest, as well, until over time, we slowly got up to the point where they're just funding the whole thing because we've been working with them for a long time now, so.
We do have a shout out from Marco Barrios that he was
uh,
actually bought his first note from you.
Yeah, Mark. Yeah, he's killing it now too. That's awesome. Good job,
Yeah.
Mark. Man, that's a really really cool. I've been seeing his Facebook posts about the different notes that he's buying, and some of the positive things that are happening there. So that's
That's
such a
awesome.
cool thing to see.
So outside the fund, do you ever sell a note to an external individual note buyer?
Yes, I do that all the time.
Okay.
So some investors don't want to invest in a fund, right? I think the fund structure is actually safer because you're collateralized against a pool of notes and not just one note at a time.
Absolutely.
But at the same time, especially because I'd have to have a 25% default rate for me to even stop hitting my investors' preferred return. On an individual note, obviously you got, risk. If that note goes into default, you stop getting paid, right? And so but we do this in pools with some of my other private investors, or on individual basis. But I usually sell one note at a time, and I'm not usually hypothecating that,
Okay.
structure. I don't mind if they go hypothecate, that's fine with
Yeah.
me too, if they want to sell
What
a
do you
piece of that off.
typically
So
sell them at? Or what do you typically originate? What's your interest rate zone so that are you creating an 8,
I'm
10,
usually
12?
creating notes in between I'd say 11 and a half and 12, and then
Okay.
selling them off anywhere between 8 and 9 to my private investors is usually
Okay.
what's happening. And so I'm making that arbitrage. And keep in mind, in my fund, for example, I have to keep those funds invested. So if you're thinking about investing and starting a fund out there, yes, it's a great strategy. So you don't have so much paperwork and back and forth with investors and stuff. But at the same time, if you don't keep that money invested, you're losing interest and you're losing your spread. And so it's really important to make sure you have enough bandwidth to keep it invested, but not too much bandwidth to where you're struggling to raise capital. So that juggling match is
The
very
juggling.
difficult. And I've actually just started to slow down massively on direct lending and just buying the paper at 12% rates. And, doing that because I'm able to raise so much capital that I'm able to get that much, additional rates. If I come in with $5 million plus, I'm getting 12% consistently on that paper, and being able to just make my spreads, and then they do all the work and all the servicing and everything else for me. But I'm
Yep.
still doing that checks and balances and actually helping those companies because I want them to be successful, and I see where I lost money, and I want to make sure they have the same risk mitigation
So you're
practices in
buying
place.
someone else's originated paper in that situation.
Right, but and usually it's strategic relationships with other big funds and stuff like that because they want to just recapitalize. Their goal is recapitalize, do more, recapitalize, and get to a bigger scale, right? But then as at that scale occurs, then quality control can be lost, and so that's when I make sure that I come in and really focus on their processes and procedures and underwriting every file before I buy it myself as well. So, and that's the key. And even if you're lending to homeowners, I find lending to homeowners is a little bit more risky from the standpoint that sometimes it's hard to get inside that house and know what the heck the preventative maintenance are, maybe you don't get complete files sometimes, all these types of issues that what if they don't really own that note? I mean, anybody can fabricate a note, you know what I mean? And so like, understanding who you're dealing with and getting true backup and documentation on the due diligence side on buying the paper. But I love that side because if you can go through and buy a partial of a note of 5 years of a 30-year note and get the full payment, and you can make 30-40% returns on your money. It's insane if you get the right structure there, so
So we had a
Very
couple
interesting.
questions. One person asked, how do you access the notes you have for sale? I would recommend there's a form in the post. Feel free to fill the form out. You're going to get Matt's information, his email address, everything else. Do that, and you'll get his information. You reach out to him directly. And then we also had a question. So you're essentially making a 3-4% spread on $4 to $5 million at any one time because you're borrowing at 8%, and you're making 12. You're making 4 or 5% constantly.
And I have 35 million lent out right now, and my goal is to get to 100 million. And it's hard to get to 100 million when you're direct originating to the public versus buying debt. Buying debt makes it all easier. And I found even a couple of
right?
yeah, and even buying
Yes.
even the origination fees that we get and the loan fees that we get for the origination, you're talking about half of the loans that come in the pipeline don't close because of one reason or another. They fall out of contract, rehab's too much, they don't have enough money. There's a million reasons, right? Or they're lying and fabricating their documentation, which happened before. I'm like, at least be good at PowerPoint and have the right or Adobe Acrobat and being able to actually make the font the same if you're going to fake your proof of funds, so but all those things are so much work, and then having to do the servicing on the back end too. It's so much work, it's not worth the points. It's better just to buy the paper, but
Right.
also understanding how do you make sure that that's good paper, that rehab bid is right, that those procedures are right, that all of those little factors that I mentioned as far as the risks that are obviously crazy concerning if you're not knowing what you're doing on that side or don't know the detailed due diligence on these things. That has to be looked at, so, and I don't like going to the public. We did it wrong in the beginning where we were like, great, I'll give somebody 100% purchase and rehab, up to 70% loan to value because I'm protected on my equity. But then you start finding a bunch of people that don't have any money and don't have any backup money. And then they start defaulting and you're going, well, yeah, because I'm targeting the wrong people, and you want to target the people that are looking at value in a strategic long-term relationship that have experience, not the new people that don't have that or don't have enough cash to be able to put that together, right? So
Makes sense.
Yeah, exactly.
So me and Nathan are all for buying this debt paper, right? That's our market. We want to we all want to stay in our lanes, right? An idea of, letting people originate paper, let them stay in their lane, let them originate, and we can buy all the paper that you guys create. I know we have a lot of originators, sub two people, wrap people, silver finance people listening and going, I'm making a ton of money on my, money up front, my points, all that stuff, which is wonderful. And that's great. We just don't want to do the hassle of having to go find that asset,
Yeah.
right? Onesie, two, if you're creating 10, 15 a month, that's a lot of work.
Oh yeah,
We
it's
just want to
huge.
recapitalize in the same situation.
Right.
So you're basically buying your own paper at par, right?
Hmm.
Because the paper being good,
Hmm.
right?
Correct.
And you're able to get 12% return, right? Normally we don't buy at par. We'll buy close to par. And 12% is a good number. I know a lot of people are targeting a little bit higher, 13, 14. Would you ever sell any of your notes to someone else for, say, a 13 yield? Or because you could buy at 12, there's no point to?
Yeah, well, so it doesn't really on a long-term note, that kind of strategy makes sense because you're just looking at the discount that you have to, sell that note for, and maybe you're profitable in that seller finance note. And so, when you're doing that type of strategy, maybe you're discounting at a couple points and you're taking a 10% discount on your note value or something to be able to get to that higher rate in that case. On a 12-month interest only note, if I was to sell at 13, I'm just paying you money for originating the note, right? So it doesn't make sense on a short-term interest only loan type situation like that because and it usually a lot of times they pay off in 6 to 8 months because the rehab's done, and so that we just do 12-month notes like that, and then we continue to do more and more of them and cycle them that way to make our spreads, right? And so in that kind of situation, it doesn't. The only thing, and I've had this same conversation with a lot of guys like you guys that
Yeah.
existing paper because it's a totally different game than the short-term construction debt aspect. You're just looking at how do I make my interest rate spreads, protect my investors at all costs, and make sure that I'm going to be profitable long term with the risk and how much risk I'm actually taking on that versus my profit, right? So
Yep.
because I always protect my investors, and whether I have a default or not, I'm paying my investors, so
Yeah.
and I'll just take over the property, go flip it, go do what I need to do. Every once in a while, I'll take a small haircut or something like that because I screwed up on a deal or something. But most of the time, if we do have to take it back, it's like a deed in lieu. They're communicating, they're having hard time, and
Gotcha.
I'm like, cool, we'll put up the rest, we'll go finish it and make our profits. And if you help us with the rehab, we'll even, after we get our money back, we'll even give you a piece on the back end, and you try to be friendly with as many people as you can on that side, so.
Interesting.
So Sal asked the question, are you using DSCR loans? All business to business is DSR basically, right?
Mhm.
So yeah, there's no owner occupants here. He's doing either rehab loans or some kind of business to business loan.
Yeah,
Absolutely.
yeah, and we're
Yeah.
doing the rehab, the direct renovation loans on one side, and then if people want to come to us and refinance on the other side, we're doing the debt service coverage ratio loans for rental properties on that side. So if they want to refinance off of our 12% money into now 7.5% money, which you can probably get it down to like 6.75, but it's going to cost you like 3 points right now to do that.
Yep.
It's insane, and compared to what it was, at least not
Yeah.
historically. But yeah, so that's usually what we're seeing right now, but it's at least better than 12% money. But it makes a rental property hard to cash flow. And so a lot of people
Yes.
are going to short-term rentals now for that strategy as well to juice the cash flows a little bit. So
So with that being said, I know that you said, long term. Do you do anything longer than 12 months or it's not even worth it for you?
yeah, actually I do. So a lot of my single families that I have equity in, I seller finance consistently. I love doing the 5-10% down strategy to a homeowner and carrying paper. I usually do 5-year balloons or 7-year balloons as much as possible. Sometimes it depends on what the rate is. If I'm at like a 7% or 7.5 or 8% rate to a homeowner, I don't really want to hold that paper long term, but I'm looking at, okay, same thing, if I sold that as a discount to one of my private investors for 9 or 10 or something like that,
You're
and
paying
what am
them.
I netting out of that deal by doing seller financing on that strategy? And usually, many times, what I'll do is I'll just collateralize my paper at 75% of market value and then keep my equity in the rest. And if you look at the arbitrage on how much equity I have in my note versus the monthly payment that I'm receiving, I'm getting a great return on my money, on my cash flow. Usually it's 10, 12, 15, sometimes 30% on my money,
Yep.
depending on how much I'm into it for of my own capital, right? And my return on equity. So I do that quite a bit. I love that strategy too. It's great.
So if
So
Nathan and I wanted to buy your paper, would you, and it defaulted at any time, like you bought 12-month paper, how would you work it out that like that rehab has to be done? Me and Nathan don't want to do it. Do you kind of back up and say, listen, I'll buy it back from you? How do you structure
we
that?
we do all the work. So we come in and say,
Okay.
okay, hey, we're going to keep paying you typically. In that case,
Mhm.
if it's a giant note or something like that,
So you don't
we'll
want to
say up
sign the note
front.
over to us.
Yeah, so we
You,
would we would assign the note and we still say that retain the servicing, and then we would just
okay.
make an agreement with you that says, hey, if you want us to foreclose on this property and pay the legal to foreclose, keep paying you your interest and put up any excess rehab funds and go flip it, we'll do that because but we keep the profit on the back end, you know. So and so that's and but we'll keep paying you, and then we'll need an extension from you to be able to do that, you know, if that's the case, if it's not, you know, if it's been 12 months or something like that and they're not paying off. But that's the worst that usually would happen to one of my investors, you know. None of my
Gotcha.
investors have ever lost money on any of my notes with me. So and I have though, you know, I've lost $1 million in the past, you know. So you once you're in the $1 million club, then great. But I had a contractor steal about a little over $500,000 on projects and gross negligence and fraud, like purposeful fraud, where they doctored
Mercury.
permits, they doctored receipts, fake
Does
pictures,
anyone
fake
see why we don't want to do this at
insane.
all? Like,
So yeah,
Yeah.
no, this is but
So
this
I
is
would
the
rather.
risk of any of the flip
yep.
business. You know what I mean? Like any
Yes.
contractor could have stolen, but it cost me $1 million because we had to redo everything with the whole properties, you know, on this, and because it was all fake. You know, he drywalled walls up with no plumbing and electrical done just to show us, gave us fake permits of the plumbing and electrical and fake pictures of another property that had plumbing and electrical done. He put he put the you know the 12-inch wall tiles that go in the shower, right? He put
Mhm.
wallpaper wall tiles up there with the squares like that that looked like they were regular tile. I'm like, you literally went to that degree to defraud. It's insane, you know. So, but this is what makes running a management company, running a lending company, dealing with contractors. I'm like, yeah, I'm a very optimistic guy, but everybody's a crook until I prove otherwise with due diligence, you know. So,
Yeah.
but yeah.
Well, we did have some more questions. Nathan, do you have a question before I go to more questions here?
I'm just wondering if you're gonna be lending on just a regular mortgage, not a flip. Any states that you would not lend in?
Um, well, now Louisiana, because I think it's like an 8 month process to do this in. There's certain Illinois is another state, California
Yeah.
is another state. I really don't
Yeah.
like tenant friendly states. I want landlord friendly states that I'm going to lend in that have, you know, the smart business acumen. You know, even though I live in communism in California, I don't invest here. You know, so and
I'm with you, Jersey here.
I'm like, where right on the Nevada border can I move that isn't just desert, you know? So I'm like, yeah, I got to go to Tahoe somewhere and up in that area. But
Yeah.
but you know, yeah, they're definitely. We're really very aware of judicial foreclosure states that they're going through that process in the beginning. Sometimes they're judicial and non-judicial foreclosure states, you know, and
Yep.
so sometimes certain states are just backed up, and you know, you should have seen the headaches that we had during COVID and stuff, just with recording documents, let alone
Mhm.
foreclosing on stuff, and you know, like
Tell us
during
about it.
that process, right? And so,
Yeah.
and of course, during our lending business during that COVID market, we were like teaching everybody how to go get their, you know, disaster relief loans and showing all of them, here's how you get your cash and go buy all your materials now so you don't have the supply chain disruptions, because it was taking, you know, weeks and weeks
Oh my
if not
Lord.
months to get appliances in, you know.
Yep.
So and it's just lost interest and lost money massively, you
So there
know.
was a question regarding your balloon that he heard 5 to 7 years is a no. Um, and just for clarity, and stay tuned to the end. I do have a thing that I told Matt before that all note buyers should be aware. I haven't even told Nathan about this yet. So stay tuned to the end to make sure to remind me to tell you guys this. But from what I was talking to Max earlier, 5 years is the minimum that any balloon has to be past 5 years. Just be notice of the fact that 5 years for any owner occupant, the minimum is 5 years for a balloon. So
Yeah, the Dodd-Frank stuff and all that kind of
Yep.
stuff is obviously the most important thing in the world. So you don't, there hasn't been any real case law that I'm aware of on this that is really hard hitting on people, on this, at least according to Max and, some of
Yeah.
our conversations with him. But
Yeah.
at the end of the day, it's still, get your paperwork done, make sure it's done right. We're actually in the process right now of starting a mobile home debt fund to collateralize the seller finance debt on new mobile homes going into parks, backed by the park as well. But
That's a big one.
yeah, but
That's a big key,
yeah,
guys. Whoever buying mobile homes, the fact that the park will actually guarantee the payments, and if it defaults, the park will actually pay you the payments.
yeah, you do not want to take back mobile homes. So, you want
Yeah.
that park and the financial strength of that park and the financial strength of and the experience of the operator becomes extremely important there as well. Who are you dealing with now as the guarantor for that? But what's interesting is we're able to structure really cool stuff. I mean, we're usually paying 12% to our investors in that type of structure. But that's, one other piece of debt that we're doing. We're also invalidating consumer credit card debt and getting legal fee receivables and collateralizing that at 25 cents on the receivable balance that has a historical collection ratio of 80% and making 30% over 18 months on our money and getting it paid back there. So this is why I love debt. There's like a million different ways. It's like, what's the collateral, who am I
Yes.
dealing with and what kind of rate can I make, what kind
And
of
what's
spread
the
can I
default?
make?
What I do in the default duration?
Right. What do I have to do to take over if that's the case,
Yeah.
So, but
How
yeah.
much default are you seeing in the business you're in with all the fix and flips and whatnot? How much default? What ratio?
So it was in the beginning when I first got started, it had to be 10%, which sucked because we were doing it wrong to the wrong people and stuff like that.
What year was
Now,
that again?
this was like 2007 or
Okay.
17 when I first started lending money. When I stopped needing capital, I'm going to networking events all the time. Like I run a nonprofit that teaches financial education and real estate education called For Investors by Investors in Southern California. And through that, I started gaining all the capital I needed for this, and I stopped needing it for my own deals. And so I started lending it to some of my really good real estate buddies and stuff like that for their needs. And that's when it was born on that side of things. And then I started doing affiliate programs and marketing out there. And that's when I was like, oh crap, let me learn my lessons the hard way, So on those things,
So what do you
realizing
said
no.
you're 10% back then? What do you think you're at in the last 12 months?
So like 1%, like or less. Yeah.
Wow.
So it's even, and usually if that's the case, if we have a default or something, they're usually friendly. And we're communicating with them saying, how can we help you guys out? Is there room for potential second? Will you do a deed in lieu? Can we do a title search to make sure that you don't have any extra liens on this property? Because we want to know if we can do a deed in lieu.
Yep,
Otherwise,
sure.
if there's a second already, then we got to foreclose. And when does that process look like? So, it's getting our stuff ready, but then saying, hey, let's be as friendly as we can. We want this to work. If this borrower just ran into a bad situation with cash, maybe we can find a way to solve it, And we even
Yeah.
hooked up with like this credit card type company that would give homeowners loans on properties that they owned for renovation jobs for contractors. And we had the contractors helping with that aspect of things to get them some extra cash to finish projects. It's like, how do I not take the risk myself, but then help them in that process, So
Yeah,
Mhm.
absolutely.
That's cool.
Well, I know Nathan is enjoying his visit with his daughter and school, stuff like that. Nathan, before you ask your final last question, I want to let everyone know.
Yeah.
I don't know the details yet. It's happened. I was on a call with Max earlier. There is a situation that if someone is active military, even if it's deployed or not deployed, they can go to their lender, and the lender would have to reduce their loan to below 6% while they're deployed or active. So just be aware, even if your borrower is at home, going to the hospital, being a nurse, but they're quote unquote active duty somehow or, activated, they can show papers and you have to reduce their loan down to 6%. I don't know the details yet, but just be aware that that is something that just came across my desk within an hour ago. So, whew,
Oh, that's awesome. That's really
yeah.
cool.
Go ahead,
All right,
Nathan.
Matthew. So what do you see? So 1% here in the last 12 months, have you seen an increase and where do you see the market going? Like I say, my concern with the short term is we saw things change very quickly. And I've experienced that myself doing fix and flips in the past.
Mm-hmm.
How are you hedging against that, and what do you see coming?
So the first thing is I want to look at each individual market, and we look at the data of the market that we're in to understand what's happening in that market. And like looking at 2008, for example, a massive crash that could occur again because they just kicked the can down the road, of course, right? From the last time. And it's just the amount of debt they pumped in the economy. In my eyes, everything is really unstable. And I'm looking for farms where I can go make my own food and stuff like that, because I don't know what the heck is going to happen, right? I'm a prepper, I'll call it, right? So at the end of the day, you know, I'm definitely concerned about what's going to happen. And so if you look at the crash last time, it took literally like 6 years to get from top to bottom, you know, 10% a year, five in year one, maybe even 5% in certain markets. And during the liquidity crunch, which is what my bigger concern is of a crash in the overall market, and a maybe crash in real estate prices with the lack of inventory right now on the market, with a lack of demand because of a lack of affordability, I don't think we're necessarily undersupplied comparatively to demand. I think what it seems like is it's pretty even, if maybe a little bit more demand than supply, because you're seeing prices still start to rise over a period of time, but not crazy, right? I think national average for like 2023 was like 6% or something, which is like, what, you know, that's crazy, you know, but inflation was probably 10, you know, at the end of the day too. So so looking out for that piece right now. If you're holding debt, that debt gets destroyed with inflation, of course, too, which is great from a property holding standpoint, you know. But I'm looking at, hey, are we being conservative on our market values? When you're analyzing market values, if it's short term like that, they're in and out usually quickly. But if it goes down by 10% in a 12-month period of time, which is a crash, a major crash, if that occurs, then where's that property going to be? What's the loan to value at that point? And so I've dialed back my loan to values from like 70 to 65 many times, unless I know it's a really, really experienced operator with a lot of excess cash that could put in a project like that to protect myself, you know. And I'm also, you know, really looking at the liquidity of that borrower in depth and saying, you know, where are they at with their cash situation? Are they sitting on a bunch of cash and they just don't want to use it all and they want to have their own reserves? That piece of it is really important. And I'm also looking at markets that didn't have a major volatility in 2008 when everything crashed, right? And you know, what kind of markets go down by a couple percent a year and go up by a couple percent a year that are a little bit more stable, like, you know, a St. Louis or a Memphis, Tennessee, or an Atlanta, Georgia, that has gone up like crazy lately. But you know, some of the sub markets, not necessarily. But I'm trying to be very conservative on where on the volatility of the markets that I'm investing in, you know. So and look at where that is in comparison. I'm also diversifying into different asset classes and different types of debt too, outside of real estate, because I'm like, that's why I'm investing in debt invalidation, because in that side of things, that industry is prone to boom, you know, over the next 10 years, right? So and so that side, and mobile homes are very recession resistant, so I'm investing in those as well, not just on the debt side but the equity side too. The last deal we picked up, we were adding 52 new units to the park and rehabbing 26, and based on our cost to value and our income, we should be at a 13.8 cap rate at our cost. Like, we put the refinance interest rate at 9 to be conservative, and then put the exit cap at 8.25 instead of 6.75, which is where market is, as if everything crashed and we're still hitting a 20% IRR. So I'm looking at the details of each investment I make, each loan that I make on this side. I actually like the fact that it's shorter term versus longer term, because if I'm locked into a 5-year loan and you're on a downward cycle of 5% a year every year for 5 years versus 5% in 12 months, and then I'm out of that transaction, and now I can recalibrate my market value on, you know, for that new next loan I want to do, and even build in a 5% discount, because I want to know where that value is going to be in 6 months from now or 8 months from now, not now. So I'm looking at the last 3 month comps.
You don't want to be the most positive. You want to, if crap happens, you're so protected. We do our bid calculators, right, all the time. Is that when we bid on something, we don't predict the best case scenario. A lot of people are bidding on stuff they expect to perform forever, and things may sell, they may default, they may all stuff. You got to predict the fact that things could be bad, and if it goes up, that's even just icing on the cake.
Yeah,
Well,
I
Matt,
agree.
I know Nathan has to go. I'm gonna do after hours with you guys. If you need the replay, if any questions, the link for Matt is in the chat. Just fill the form out, and he'll get the information from you, and you'll get an email from us saying Matt's information. Matt, it was an awesome conversation. I'm getting a lot of feedback. Thanking you for your
Yeah.
time and your
No problem.
information.
Thank you,
It
guys.
was awesome to learn, and I'm sure you'll be hearing more from you. Matt also has his own YouTube channel. Reach out to him, and he'll share all the details you need from that. But for now, we're gonna disconnect from the public. Have a great weekend, everyone. Take care.